as the Chief of Staff and Chief Deputy Treasurer of the IAC meeting to order. Welcome to all the IAC members, IMD staff, and guests on site and calling in. I ask you to join me in the Pledge of Allegiance. Pledge allegiance to the flag of the United States of America, to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. Salute to the American flag. I salute the flag of North Carolina and pledge to the whole North State love, loyalty, and faith. Thank you very much. I will now ask legal counsel to call the roll of IAC members and verify whether we have a quorum.
Morning, everyone. This is Jason Sass, Assistant General Counsel, acting on behalf of Ben Garner, General Counsel for the Department of State Treasurer. First, I'd like to take roll call of the committee members to confirm we have quorum. And then we'll go over a couple of reminders for the public meeting. For the roll call, Mr. John Anarella. Here. Mr. Lance Brewer.
Here.
Mr. Loris Coakley. Mr. Michael Mebane. Mr. Greg Patterson.
Present.
We have quorum. Well, we need to wait for Treasurer Falwell, then we'll have quorum.
So I double check and make sure some of the others were on mute or not.
Yeah. Could we call again Mr. Loris Coakley? All right. And Mr. Michael
This is Greg Patterson. I can see Loris listed. Perhaps he's looking for his mute button. Loris, it's up on the right-hand side below the orange arrow. It took me a while to find it myself.
Thank you. We'll just wait a moment.
Mr. Secretary, I'm a delegate to several boards. In the absence, can I be representing the treasurer to achieve quorum or no?
I think we don't have allowance for that.
Okay.
Their charter. So.
If I could just share, this is Gail. Mr. Coakley is listening on his phone. He is driving in his car on the way to a doctor's appointment. So he's on his phone and it was going to sync with his car. He wasn't sure if he was going to be able to speak, but he is definitely listening in on the meeting.
Okay, well, we'll just need to wait until we can hear confirmation. Apologies, everyone.
Okay, we'll without objection, we'll pause for a few moments to try to reach a quorum. Mr. Secretary, there's not much business we can conduct until we have achieved quorum. Is that correct?
That's correct.
Gail, can you tell if Mike Mebane is on?
I can, Mike Mebane is not on the line. I was told yesterday that he would probably not be able to, by the treasurer, he would not be attending.
All right. We'll just hold for the treasurer to arrive.
Those on the phone, this is Ted. I presume everybody's okay with us pausing for a few minutes and stay in session as opposed to going in recess. I don't think it's necessary at this point, especially if we have somebody just trying to verbally tell us. Can they do it via text? Jason?
Can't text and drive. Hopefully, if she's not driving, you won't do that.
Yeah. Well, one of the problems we have is that if he's got another appointment as well. If he drops out, then we also won't have quorum. So we need to make sure we have communication.
As I presume Anna's text to treasurer. Let me see if he's.
Treasurer, Anna said the treasurer should be here momentarily.
Okay, we're good. It'll all be good. All the day's work.
There we go.
There he is as we speak. Mr. Treasurer, you'll now make quorum. Jason's going through them. We could have called in.
We're just going through it right now, so.
The gavel
Nate
man.
said you were coming.
Just wait for that.
I'm on the button. All right.
All right, one more time for the roll call. Mr. John Anarella,
Here.
Mr. Lance Brewer,
Here.
Mr. Loris Coakley, Mr. Michael Mebane, Mr. Greg Patterson,
Here.
Treasurer Falwell.
Here.
Now have quorum.
Thank you. Members, I want to apologize. As some of you know, I am on the OPEB committee and I also chair the State Banking Commission. And the State Banking Commission met at 9 o'clock this morning. And as you can imagine, a lot going on in the banking system right now. So that meeting ran long and I apologize for keeping you waiting. I don't think I am known for doing that. So thank you. They already done the pledge?
Yep.
Yes, sir. Good. And conflicts?
I just want to go through the reminders right now.
Okay.
So thank you, committee members. Here's some quick reminders for the public meeting. For those who have called in, please remember to mute your phone when you are not speaking. Please state your name when making or seconding a motion. If you do need to leave the meeting, please speak up to let us all know. And if you rejoin, please identify yourself. Finally, for anything that this commission votes on, the votes will all be by roll call. They'll deem the members who make the motion and second it as voting yes. Today's meeting agenda is posted for public availability on the Department of State Treasurer's website. If we lose the phone line connection altogether, the meeting will be deemed to be in recess and we will put a notice on the nctreasurer.com website homepage when we have information about a time to resume the meeting. Are there any questions about these procedures? Well, thank you very much. This time I'll turn it back to the chair for approval of the last meeting's minutes.
Thank you. I'd like a motion to approve the previous meeting minutes.
This is John Anarella. I approve.
Thank you, John. Second,
Greg Patterson, second.
and any further discussion? If not, clerk will call the roll.
For the roll call, Mr. Brewer,
Aye.
all right, and treasurer.
All right, we're now to our performance update by our co-CEOs, Christopher Morris and Jeff Smith.
Good afternoon, everybody. Just taking a quick look back at the first quarter of 2023 to recap. We had the ongoing story, certainly battle with inflation that we've been talking about for multiple quarters here on end. The readings remained elevated throughout the quarter, but we did see continue to decline from the previous high levels, with the year-over-year numbers falling below 6% during the quarter. We had 2 more rate hikes during the quarter. We've also had 1 since the quarter end. That makes it a total of 10 straight meetings and a total of 500 basis points in 14 months. Much discussed that had been kind of an unprecedented level, certainly in recent history, that quickly. The next meeting is scheduled on the 14th of June, and futures this morning showed roughly a 50-50 chance of another 25 basis points, but close to 100% when you look at either that or the July meeting following that. So Fed still seems committed there to tapping out the inflation, since it's not down to the level that they really want to target. The other new story added to things beyond inflation was certainly the banking side of things. We saw SVB and signature banks collapse that required intervention by the Fed and the U.S. Treasury that added kind of to the uncertainty during the first quarter. Despite that spike in uncertainty, we saw stocks and bonds see positive returns during the quarter. On the equity side, growth stocks led the way, particularly tech names, while regional bank stocks really struggled with what happened there and with SVB and Signature. On the rate side, intermediate and longer Treasury yields declined roughly 30 to 40 basis points from the year-end levels, while short rates spiked on the rate hikes by the Fed. The spread basis, investment grade credit were slightly wider, really not much, though 6 or 7 basis points on average, while we saw high yield continue to tighten slightly. So that's a brief look at what happened in the quarter.
Good morning, everybody. This is Chris Morris. Moving to slide 7, I'll start the portfolio update. Assets under management as of the end of Q1 was 170.5 billion. It's up about 5.6 billion for the quarter and up about $3.5 billion since for the fiscal year since June of 2022. All of the programs increased in value for the quarter as markets rallied. Change was driven mainly by an increase in the NCRS assets, which were up about $3.9 billion. Cash management program was up about $850 million, with the supplemental retirement programs up about $700 million, and the ancillary funds up around $100 million. Moving on to slide 8. A look at the NCRS asset allocation as of the end of Q1. The portfolio ended the quarter at $113.2 billion, up from $109.3 billion at the end of the year. No major changes in portfolio positioning, although the growth underweight decreased by close to 1% with the equity rally to 6.2%, and corresponding decrease was to the overweight in rates and liquidity by about 0.8% to 5.5%. Inflation sensitive and diversifiers portfolio was just under target, which is consistent to where we've been for a while, with an underweight to the inflation sensitive asset class and an overweight to core real estate. And multi-strat remains at 2%, which is a modest overweight of 1%. Moving to slide 9, which shows a more recent snapshot of our asset allocation. Quarter to date, markets have been pretty flat. We've seen some volatility, but the portfolio itself has hovered right around the $113 billion mark since the end of Q1. No major changes in allocation since quarter end, although one thing to note is we've begun intentionally bringing our investment grade fixed income allocation back to target weight, given how far rates have moved. And you can see as of here, it was an underweight of, as of May 18th, it was an underweight of about 1%. It's about 1.5% at the end of Q1. And through yesterday, it's down to about a 70% underweight. So we've been trimming that underweight, getting closer to neutral with regards to our IG fixed income allocation. Moving on to slide 10. The portfolio returns. Portfolio was up 3.8% for the quarter as both equity markets and bond markets rallied, with equities up more than 7% and bonds up more than 3% for our portfolio. Fiscal year to date, the return is right at about 3.3% through the end of Q1. You can see the 1-year number being negative 3%. Most of that driven by the tough 2022 that we saw, specifically the last 6 months of this 1-year period, or the first 6 months of this 1-year period, sorry. With the positive return for the quarter, the portfolio pulled ahead of the actuarial rate of return of 6.5% for the 3-year time period, and it's remained above it for the 20-year time period. But for the other time periods measured, it's the return has been below that 6.5% bogey. Relative performance for the quarter was slightly behind its benchmarks, but significantly ahead of both our benchmarks for the 1-year time period. And we'll look at the attribution of that in a bit. For longer time periods, we're still showing strong relative returns versus both benchmarks for 5 years and longer. As you can see, strong relative returns, specifically on the longer time periods against both the implementation benchmark and the long-term policy benchmark. Looking at Q2, as I mentioned, we've seen some volatility in markets, but not much movement either way, with equities slightly up for the quarter, our fixed income slightly down for the quarter, but as a whole, the portfolio is pretty flat for the quarter in terms of return. Moving on to the next slide, slide 11. It's our growth of a dollar chart. Doesn't change much quarter to quarter. Shows the growth of NCRS versus both of our benchmarks, the implementation benchmark, as well as our long-term policy benchmark. And as you can see all the way on the right, the orange line, which is the pension plan portfolio, is above both of those benchmarks for the long term, specifically above pretty significantly versus our long-term policy benchmark, which is what we want to see, since that long-term policy benchmark just measures kind of a passive implementation, passive low-cost implementation of a portfolio with our similar risk profile. Moving on to slide 12, similar charts showing with 2 different time periods, 5 years and 10 years. And then we've also looked at kind of how our alternatives portfolio has done for both those time periods. You can see that green line is above both the total pension portfolio as well as the long-term policy benchmark, which is showing that those have added value over that time period. Although you can see the alternatives we've seen kind of flatten out over the last couple of quarters here, as you can see. Slide 13. This shows our contribution to total plan return for the 1 year ending March 31st. This shows kind of how each asset class contributes to the total return, both in percentage basis as well as in earnings. So you can see the negative 3.7% return for the 1 year equates to a loss of approximately $4.3 billion in earnings. And you can see the drivers of that. Really, public equity and IG fixed income were really the drivers of that negative return at the total plan level. And, that was driven mainly by, what we talked about the last quarter, what we've talked about a while, just the negative environment for both stocks and bonds for that time period, specifically kind of the second and third quarter last year. You can see that the alternatives on this did add value as well as cash. And you can see how that specifically inflation sensitive asset class, as well as our cash portfolio, really help protect on the downside. So those asset classes are kind of doing what we expect them to do. And it's good to see that that's helping in this environment. Turning to the attribution on slide 14. As I mentioned, the portfolio outperformed our policy benchmark pretty significantly for the 1 year time period by 1.45%. You can see that value add was driven by both the selection effect, which is how each asset class performed versus its underlying benchmark, as well as the allocation effect, which is how the portfolio is positioned versus its targets. So you can see how on the allocation side, the overweight to cash added about 1% of value. The overweight or the underweight to public equity added about 20 basis points of value on the total plan level. The other thing I want to point out is on the selection effect, you can see how much value both public equity and IG fixed income added. Kind of looking back at the previous slide that showed those are the biggest detractors to the total portfolio return, which is true. Both those asset classes had negative returns for the 1 year period. But you can see how the management of the team and the active management versus our individual benchmarks have added value on the downside. It's just another measure of kind of the downside protection of the portfolio, where both public equity and IG fixed income added 40 basis points each to the total return, even though those returns were negative, right? So just another way to look at kind of the downside protection of the portfolio and how those portfolios performed for the 1 year time period. Looking quickly at the 3 year, you can see a little bit different story here. The portfolio underperformed the benchmark by about 1.4% for the 3 year time period. And thinking about that time period, the start of that 3 year was really April of 2020, which was right after all the COVID shutdowns, right after the market fell pretty significantly in March of 2020. So you can see the start of that was really the start of that 2 year bull market or year and a half bull market of markets rallying at the end of 2020 and throughout 2021. So you can see how the positioning of underweight to public equity and overweight to cash did not pan out during that strong environment for markets, which is what's driving the allocation effect there to be negative. Still see a positive selection effect, which is nice to see as well over that time period, specifically with that IG fixed income outperformance at 40 basis points annualized on this 3 year period, which I know we've talked about before. And then a quick snapshot of 5 year, you kind of see a combination of what we just talked about in the last two. Portfolio and the benchmark were flat, both returning 5.1% annualized for that period in time. And you can see that the outperformance was driven by the selection effect, while the underperformance by the allocation effect. And again, on the selection effect side, you can see that virtually all asset classes added value over that time period, which is certainly something we like to see over the longer time periods. Moving on to slide 17. This is our risk metrics slide, just showing various data points points with regards to volatility and tracking error and information ratio and Sharpe ratio. And I just want to point out kind of what we're seeing on the volatility side. If you look at that top left chart and the blue line there, you can see how volatility has really spiked in the last year or so. And we're seeing that really across the board. And we're seeing that essentially the last 3 or 4 years, ever since the COVID pandemic hit, where for really most of the 2010s, you had this extremely low volatility environment. And you see on kind of those longer time periods, the 3 and the 5 year, you can see how that was well below our averages. But you can see how that's spiked up in the last few years ever since that. So, it really feels like there was definitely a shift in regime in terms of markets and in terms of volatility. And obviously that there's a lot of reasons for that, but we really saw that starting with the shutdowns due to COVID, and then going into this current environment with the high inflation and the unwinding of interest rates and the unwinding of all that fiscal stimulus that we saw as a result of those shutdowns. So we continue to see higher volatility, and I would imagine that probably will for the foreseeable future. Moving on to slide 18. Doesn't change dramatically from quarter to quarter. These are just other metrics with regards to our kind of downside capture. As we would expect, both versus our implementation benchmark and long-term policy benchmark, the portfolio won't keep up necessarily with strong markets, but will protect much better in the downside. And that's kind of what you're seeing with all those data points on the top half of that slide. And then on the downside, it shows kind of how the portfolio performs during drawdowns. With the latest drawdown all of throughout 2022, you can see the orange shaded is the portfolio itself, and those 3 lines, the blue, yellow, and green lines are the different benchmarks that we measure ourselves against. And you can see that the portfolio itself outperformed all of those during the drawdown, which is what we would expect given a kind of more conservative profile. Moving on to slide 19, universe comparison. As we talk about pretty much every quarter, our portfolio is more conservative than a lot of our peers for a lot of different reasons. And you can see that with the bottom half of that slide in the risk profile, where we're in the bottom quartile in all of the longer term time periods. But that also leads us to be lower on the return side as well. For the 1 year though, we were in the top or the top half above median for the returns and just below median for the risk. So with the markets that we saw, with the negative markets both on the equity and bond side, the portfolio did perform fairly well versus our peers, given what we saw in the markets. Slide 20 just shows it's another metric, universe comparison, Sharpe ratio. That's a measure of kind of the risk adjusted return. So it combines both the returns and the risk. Longer term time periods, we typically see this as a very strong metric for our portfolio, which you can see out of the 10, 15, 20 year, we're above median and even top quartile for those metrics, and a little bit less so in the more recent past. Looking at our liquidity profile on the next slide, this shows our liquidity allocation both in dollars and in percentages. We like to ensure that the portfolio has enough liquidity. We measure this on a regular basis and kind of track all the asset classes based on 4 levels of liquidity. Level 1 being the most liquid, level 4 being the least liquid. And by policy, we try to have at least 70% of the portfolio in level 1 liquidity, which is the blue bars on that chart. And as of the end of Q1, we were at about 75% level 1 liquidity, so well above kind of our policy minimum. Next slide shows benefit payments by calendar year. Nothing really new here. We continue to see those decrease year over year. We would expect that to flatten out, and early projections for this year is that it will start to peak up. But again, we'll have to see how the rest of the year pans out. But we are paying, north of $2 billion per year net benefit payments out of the plan. So that's net of any contributions that are coming in. We are paying over $2 billion But by policy, we like to have less than 3%, which we've been, which is what that orange solid line is. And we've been below that 3% for a number of years, which is what we look for kind of from a policy perspective. Then the last slide, two more slides, I guess. Next slide shows alternatives liquidity profile. We have seen this flatten out a little bit in terms of our net cash profile. The top chart shows kind of the past 12 months for each alternatives asset class, and then the total with regards to distributions received back from these funds, as well as contributions and investments into these funds. The bottom shows kind of the average monthly flow. So you can see on the top right there, the net cash flow in that we saw the prior 12 months was about 1.5 billion, where we sent 3.6 billion out and received in 3.6 billion and sent out just over 2 billion. So net cash flow into the plan, 1.5 billion. We've been net cash flow positive for a number of years now. That has decreased some as we've seen less transactions towards the end of last year with the markets. But we do continue to see a positive cash flow profile, and we foresee that being the case for the foreseeable future. And then the last slide I'll hit before I turn it back over to Jeff is the valuation lag profile. So this shows how frequently our portfolio is valued. A lot of the less liquid assets are not valued on a daily basis, valued either monthly or quarterly. So you can see that the blue here shows all the daily valued. The orange and gray kind of show the monthly valued, either no lag or a month or a 1 month lag. And then the yellow there show kind of the quarterly valued. So 74% or so of our portfolio is valued on a daily basis. And then another 9% or so is valued monthly, with the remaining kind of 17% that's valued on a quarterly basis with a 1 to 3 month lag. So over 80% of the portfolio is valued at least monthly. So it's obviously a pretty up to date in terms of our valuation of the portfolio. With that, I'll turn it back over to Jeff to look at the asset class performance.
All right, I'll pick us up on slide 25, our asset class net of fees performance. Just kind of taking a look at the 1 year number, touched on a little bit, Chris, a little color on the challenges in the markets in those time periods, and that bears out here as we look at it by asset class. You see kind of the rough year for public equity, private equity, non-core real estate, IG fixed, all kind of on the weaker side by asset class. And we certainly touched on many times the timing difference that comes into private versus public on valuations that we see when we look at shorter time periods like this. But kind of washed out over time. We look at the longer time periods and kind of the premium for liquidity in private versus public equity. On the stronger side there, at least on a relative basis, if we look at the 1 year, inflation sensitive, really our top performer. Kind of good to see with inflation in our environment in the last year that did what it's supposed to do. Cash at 2%, and then multi-strat was also positive. So let's see what it looks like there. On the next page on 26, no real comments here since this chart really is just the far right column only represents the quarterly numbers, which we've talked about already. So nothing really different than prior slides there. Moving to 27, new incremental and unfunded investment commitments. On the left hand side there, you see we only have one new item that's on the inflation side for 200 million commitment. And then on the right, looking at the unfunded commitments by asset class and in total, I'll tell you that it's roughly the same spot as it was when we sat down for the last meeting, maybe 30 million higher, but pretty much the same level on an absolute amount that we on a total basis at least. On slide 28, looking at that data a little differently here, the new and total unfunded commitments. And you can see where we are. The dark navy bar in the line chart, there's not bar, the line is 6.21%. It's down slightly. We were at 6.4% on that when we sat down for the last meeting, but still at a pretty low level historically as far as where we stand there on unfunded items. No real comments on 29, asset allocation history. That doesn't really change much over time. On slide 30, nothing to report on exited investments for the quarter. And then finally wrapping up on slide 31, the top 20 investment managers on here. There's no real actual change on here. If you were looking at it versus the last year, then the only difference is at number 11, it would have said Landmark in there last time, and now it's under the Aries management name. So other than that, the groups in there are the same as when we looked at it last quarter. That's it for the performance review. Be glad to take any questions anyone would have on that.
Hey, this is John Anarella. Jeff, where are you all concentrating your buying on the IG fixed income now that we're getting closer to our range?
So the bulk of the transfers that we sent in, which is I think we're up to 1.2 billion, I believe, that we've moved over as of today. Really what we focus on there is we talked a lot before historically about where we were short duration, and with rates going higher, we really look to try and work towards eliminating that. As such, trying to pull that duration up, we focused a lot on the treasury purchases in the longer end of the curve, 20, 30 year kind of area. And then we've tried to push in our new corporate deals that we're doing for new credit or extensions out of some longer bonds that we really were staying out of for a few years. They were rates where they were at low. So really on the longer end of the curve is the short answer.
All right, thank you.
Other questions? Okay. Hearing none, we'll next go to
Morning. Microphone over here. Introductions first. My name is Troy March. I'm the Director of Real Estate. I'm joined by Casey High and Chris Ward. And if we just jump right up to page 4, we'll jump right in there. If you read the headlines, you might believe that all commercial real estate is either currently very challenged or heading in that direction. And there's no denying the fact that office is struggling and likely to get worse before it gets better. Malls are still struggling. However, even in those sectors, there's nuance. New trophy Class A office buildings are leasing at rates higher than 2019. Outside of the trophy assets, other office assets are very challenged. Retail, other than regional malls, retail has actually done very well over the last year. Retail as a whole was one of the better performing sectors over the last year, with grocery anchored and small retail leading that sector. Fortunately, we have invested very little in either office or retail over the last 7 years. We had only one commitment in our private portfolio where it was even possible to get exposure to either of those sectors, and that was Blackstone's 2018 vintage fund. That fund is now fully invested and has less than 1% exposure to traditional office and only 1/3% exposure to retail. Our more recent Blackstone and TPG commitments may invest in those sectors, but that is currently not a focus for either fund. So very little exposure to those two sectors recently, at least. Overall, for virtually every sector, the financial markets could be described as frozen. Very little transaction volume is taking place. I believe this will start to change in the second half of this year, or when the Fed finally signals that they're done raising rates. One positive impact of this is to development starts. Even in the industrial sector where demand still exceeds supply, development starts are off by 40% over the last year nationally. Residential is similar. This slowdown in starts will provide tailwinds for those sectors and will help office eventually find its equilibrium. I've got a lot of talking points for each of the various sectors, but for now, let's skip over that and we'll see if we have time to circle back to that. Next slide.
So I'm on slide 5. Since we spoke to you guys last year, we've made 1.5 billion of commitments across 4 private real estate strategies and 1 listed real estate strategy. All of the private fund commitments were in our non-core portfolio as we look to increase the weighting of that portfolio closer to its strategic target. Our focus continues to be the growth of our separate accounts, but the two commingled funds that we invested in are going to provide us with global diversified exposure that would otherwise be difficult for us to replicate through our separate accounts. The bulk of these commitments remain uncalled except for the $300 million allocation to REITs, which was fully deployed over a 5-month period from last November to March. And we believe the timing of these commitments really puts our portfolio in a good position to take advantage of the depressed valuations we're seeing today. Flipping to page 6, our total real estate portfolio is roughly 74% core and 26% non-core. Strong 1-year performance of our core industrial, multifamily, and retail separate accounts has pushed the value of our core portfolio up meaningfully over the last 12 months. The $300 million infusion into our REIT strategy that started last November and completed in March has also contributed to the growth of our overall core portfolio, while valuation write-downs and distributions from our non-core funds have kept that portfolio below its 3% target of total plan assets. So as you saw on the last slide, we made $1.2 billion in commitments to non-core strategies last year. That money's been slow to be deployed this year given the state of capital markets. But once interest rates stabilize, we think capital markets will open back up and we expect that dry powder to come off the sideline and our non-core allocation to increase. Lastly, I think it's worth noting that while our allocation to real estate as a percentage of total plan has trended downward since 2018, the dollar value of the portfolio has consistently hovered around the $9 billion mark. Flipping to page 7. So taking a look at annual cash flows, you can see that we've been averaging more than $600 million in net distributions per year since 2017. This year, however, it's likely that both contributions and distributions will be much lower given the state of capital markets and much lighter transaction volume. But we'd expect that to change as soon as capital becomes available and the pent-up demand to transact leads to a pickup in deal activity.
Slide. You've heard us mention many times our focus on separate accounts, so I thought we'd focus on that here. Our focus on separate accounts is for a multitude of reasons, including better control over asset allocation, both from a sector and geographical perspective, better control over liquidity, control over the leverage profile of our assets, reduced fees, and improved alignment of interest. This chart highlights the growth of our SMAs over our separate accounts over the last 10 years, increasing from 17% of our portfolio in 2013 to 31% today. In December of 2021, we converted our multifamily separate account to an open-end fund in exchange for a permanent meaningful fee reduction and to enhance our diversification profile in that fund. As shown by the dotted line in the chart, if that multifamily fund was still included, our total would be roughly 46% of our total portfolio. When this fund was launched, we were 100%. Today, we represent about 67% of that fund, so still the majority owner of those assets. Our diversification has improved as well as our return expectations for that fund. Our focus going forward is to continue to look for differentiating separate account opportunities with best-in-class managers, and the majority of our new commitments going forward will likely be in separate accounts, not commingled funds. Next slide.
All right, on slide 9. If you look at the left-hand chart, you see fees remain low and they continue to decline. This downward trend over the last 10 years is really a direct result of us moving more and more of our exposure into those separate accounts that Troy just described and away from closed-end commingled funds where fees are usually higher. We believe holding high-quality assets longer term reduces a lot of friction costs, particularly fees on committed but uninvested capital during the initial investment period. And then in the right-hand chart, you'll notice a spike in incentive fees in 2021. That was mainly a result of crystallizations that we had in both our large industrial and multifamily separate accounts that year.
Diversification. Last year, we told you that one of our goals was to reduce our exposure to core office and increase our exposure to industrial. Over the last year, core office has fallen from 32% to 21.6%. And the 400 basis point overweight for core office has fallen back to parity with benchmark. Industrial has risen from 20.8% to 24.9%, but the underweight to industrial has unfortunately grown from 450 basis points to 630 basis points. We remain bullish on the near to intermediate term outlook for industrial. We'll continue to look for opportunities to deploy capital in that space. This industrial underweight, however, will continue to produce performance headwinds relative to our benchmark. Residential, total residential went up from 30% to 33.6%, which we're happy about that. Going forward, we wish to reduce our office exposure further, maintain our residential, retail, and hotel positioning, and increase our other positioning, which will mostly come from our recently launched separate account for self-storage. Slide. Not much has changed with regards to our geographic diversification over the last year. Our non-core exposure, our non-US exposure has dipped slightly from about 15% to about 12%. But the recent commitments that we made to global opportunistic funds should provide a boost to that going forward. Slide. 1 year ago, lots changed in the past year. 1 year ago, real estate looked awesome. Real estate was up 18.7% for the 1 year period, and REITs were up 15.4%. This past year was rough, due primarily to the drop in REITs and large office write-downs. The 10-year return at 9.2% remains strong, but that dropped 130 basis points from last year. Our return expectations per the recent asset liability study are 6.3% for core and 8% for non-core. Considering we're 74% core and just 45% leveraged overall in the portfolio, I think our 10-year performance has been great on an absolute basis, but especially on a risk-adjusted basis. Slide. On an absolute basis, strong performance from industrial, multifamily, and retail in the 1 year period helped to offset poor performance of office and global REITs. On a relative basis, the significant underweight to industrial was and continues to be a detractor to performance. Industrial, for example, in our benchmark, the 1 year period had greater than 30% returns, and given we're underweight 630 basis points, that just creates headwinds there. The 10-year performance of 7.8% exceeds our actuarial assumed return of 6.3% for core, and we exceed that for every period except 15 in the 1 year period. Next slide. Non-core. Non-core is more challenging. Our underweight to industrial of 340 basis points hurts, but a large part of the near-term underperformance can be explained by vintage year exposures. Our non-core portfolio has shrunk by a third over the last 7 years, 3.3 billion to 2.3 billion. Our remaining portfolio now has a large percentage of legacy assets. Legacy is defined by 2013 and older vintages. Currently, 25% or almost $600 million of our portfolio is in these legacy 2013 or older vintages, 39 of our 62 active funds. 2012, for example, 2012 vintage has $91 million of remaining NAV. That vintage overall had a 14.8% since inception IRR, but in the 1 year period was negative 30% return. Despite being 25% of the total, these legacy funds attributed 65% of the negative 4.9% one-year performance. Even good funds will have challenged assets at the tail end of the fund life. Near term, I would expect continued headwinds for the non-core portfolio due to these tail positions and the J curve of the recent commitments that we've made. But then I would expect this portfolio to return to outperformance in a few years, both on an absolute and relative basis. Slide. Not a lot to say here, but recent commitments give us dry powder at a great time to have it. And yeah, I will leave it to treasurer and other committee members if you want to circle back and talk about the individual sectors, or we can be done.
Questions from the board? No questions from the board? Did you go over the new investments?
I talked about them from the ones we made last year. Talking about those? Yeah. We didn't get into detail on each one, but yeah, we did 1.5 billion of new commitments. Most of it private strategies.
As far as our geographical, either one of you can comment on our geographic property diversification on page 10. Excuse me, page 11. We hear about things going on in the West, you know, these major retailers pulling out of cities because of issues about crime. And does this chart say that we have 40% of our portfolio in the West?
That's correct.
How should we be comforted by that, given what we read?
Well, we have 1.3 billion in our industrial portfolio and a large, I don't know what percentage is in the Inland Empire, but I would say a pretty good percentage of that is in the Inland Empire. These are large markets. California is the largest economy in the union, and San Francisco, Seattle, LA, they're large markets.
I'd also add that they're supply constrained markets, which our portfolio kind of has a heavy footprint in. So from an ownership perspective, that's really favorable for us being in supply constrained, specifically coastal markets like the West Coast.
So no concerns?
No. I mean, sure, there's concerns of downtown San Francisco office. That's a concern, yes. I would say even residential in that market, because for similar reasons is a concern. But there's, like I usually say, when it comes to real estate, it all depends, and it depends on very specifically what sector and what market you're talking about. A market could have good sectors and bad sectors, and a sector could have good markets and bad markets. It just depends.
So when you say the West, are you saying specifically west of things that border the Pacific Ocean?
I would say that's generally correct, yes.
It includes Denver and Phoenix as well.
But our exposure in Denver and Phoenix are pretty low.
Probably pretty low.
So what percentage of this 41% is in San Francisco?
I don't have
10% roughly.
10 is with 40.
Roughly 10% of the 40. Yep, 4% of the portfolio. San Francisco.
Start a little. Okay. I know you met.
Yes, sir. So
I didn't hear it clearly. So
41% of the portfolio is in the West, and of that 41%, 10% is in San Francisco.
okay. And that is in San Francisco. How is that broken out by property type? Generally.
Office and multifamily.
So what?
We were out there recently. We toured 4 downtown San Francisco office properties because we were concerned about it ourselves. And we were out there for other reasons. We wanted to take the opportunity to see those assets. And so we toured 4 downtown San Francisco office properties, and it was quiet. It was very quiet. Not a lot of people in those buildings, but those buildings still remained cash flow positive, covering their debt. And the good news about those 4 buildings is they had locked up long-term debt before the run up in rates. And they had 4, 5, and 6 plus years of term across the 4 of term remaining at that, lower long-term debt. So, hopefully they can ride it out and come out the other side of it. We'll see. I certainly have concerns of it for sure.
And the multifamily assets are performing really strong.
Yes.
Okay. So when we see articles, which not a lot of people like, somebody reads the Wall Street Journal, but when you see an article where a building was just built for $120 million, it just traded at $60 million before the certificate of occupancy was barely even issued. And I'm sure others are seeing this on the debt side also, in terms of the stress. I mean,
I would not have wanted to invest in office over the last few years at kind of peak valuations. Most of our office, of our total office portfolio, 46% is in our separate accounts. And most of that was bought a long time ago, in 12, 13, 14 at the latest. Those assets are doing fine. Matter of fact, on a cash flow basis, NOI, we were looking at this yesterday, NOI in our separate account office assets actually went up since 2019, despite the fact that occupancy has come down some. The debt is low because we control the asset. We're the only investor in those assets. The debt is low. Any debt that's rolled in the last year or so, we've been able to refinance, and I'm not concerned about our assets that we own in our separate accounts losing any of them over debt issues. Yeah, as I said at the very beginning, the headlines are dire, and office is challenged. And office is going to get more challenged. Fortunately, we have a modest amount of exposure to office. I said in the meeting before, as far as REITs go, there's only 9% of the total U.S. REIT universe is actually office. 90% of the rest of the U.S. REIT universe is other than office. So as bad as office is just a part of the commercial real estate world. And you could think office is terrible, and it is right now. It's really tough, but it's only a part of the commercial real estate world.
But when you're, I'm gonna call on a minute, but wouldn't your PE vault premiums or lack of premiums
Discount to NAV?
Yeah, because I mean, most people don't know that it's only 9%. They just see the headlines.
Yeah.
I mean, does that reflect itself in the PE valuations of those REITs?
It does, and that's why I think that right now REITs are an opportunity. I think a lot of the REIT universe has got caught up in the headlines of commercial real estate that everybody associates the pain that office is suffering right now, and people associate the whole REIT universe along with office, even though it's not. I mean, industrial is running and gunning. Data centers are doing very well, but the valuations of them have gotten impacted when maybe they shouldn't have really at all, or not as much, at least not to the same magnitude.
Ron, do you have something?
Yes, sir. I was going to say that some of the stress you see in the marketplace, or whether or not it's via newspaper article or anything else like that, it's also an opportunity for some of other managers, more value-oriented managers, distressed-oriented managers to step up. And in particular, as it relates to the office situation, one of our managers is doing an office conversion in New York City, where they're converting an office to student housing, given the amount of demand. And so a lot of the stress that you're seeing, we're able to capitalize upon with the appropriate conversions where somebody is able to buy discount, whether or not it's a buying out of CMBS trust or some distressed opportunity, implement a CapEx plan to convert that particular asset to a performing asset. So yes, the real estate market from an equity owner's perspective may be more volatile than one would want it to be. But sometimes volatility creates opportunities where a high quality, thoughtful manager may be able to enter the marketplace, whether or not it's on the debt side or whether or not they're able to reposition an asset for future leasing.
And from the debt side, wouldn't you see the pain start before they see it start? And wouldn't you see it end before they see it end? From a debt standpoint?
I don't necessarily know about the timing of which one starts to see it start first or end first, but the risk profile on the debt side is much lower, given that you're able to make a loan at a lower LTV, or in the event that the equity operator was unable to make a debt payment, you're able to own that asset at a much lower price to original purchase amount.
So we're dealing with the liquidation of some of these major banks that have been in the news today. Another job I have around here. So what's happening with those portfolios, those debt portfolios, or those
I've
loans?
seen some statistics on that recently. I don't remember what the numbers were. I just remember the order of magnitude that the point of was at the Blackstone meeting last week, that the total amount of the debt from those small regional banks, the amount that is actually in office is a small amount relative to their total book.
And Ron, for the record, could you state your name and position?
Ronald Funderburg, I'm investment director for the opportunistic fixed income and the inflation sensitive and the multi-strategy portfolio.
You have anything to add? I was getting ready to say something. We have $1 billion in REITs.
That's correct.
And how much unfunded? Have they drawn down all the billion?
Yes. Yeah, from November to the end of March, we dollar cost averaged in.
And the billion was 1.4. And then because of capital gains.
Now, we were at approximately 1 billion before the drawdown last year. Drawdown took it down into the $700 million range. With the 300, we're back to $1 billion.
But at the 700 range, that was basically our cost basis.
We're still
Basically gave up all the gains.
we're still slightly positive on our REIT investments. I looked, I don't know, 2 weeks ago, we were up 4% inception to date over the 7-year plus period with BlackRock. So still positive, but the drawdown has pulled that back up. A year ago, we were at, I think, almost 12% inception to date with BlackRock. That's come back to about 3 or 4%, I think.
And lastly, what's the upshot of the Blackstone conference?
I would say as
And
kind
for
of
the,
like,
can I interrupt you for a minute? For the members, all that you're hearing about the run on the bank, so to speak, on BREP, is it BREP?
B-REIT.
B-REIT. Okay. For all the IAC members, when you read about Blackstone, it's very, very important that you read the fine print of which fund they're talking about. Because if my memory's right, we have no exposure to B-REIT.
no exposure to B-REIT.
No exposure.
None. That's a retail fund.
Right. But they put the gate down on something we do have exposure on.
Blackstone Property Partners, which is a core
BP.
plus institutional fund.
BPP. So what was the upshot of the meeting?
Everything's not as dire as the headlines might proclaim it to be. There's opportunity. I mean, Blackstone is a global fund, so they're looking at opportunities everywhere. They really like Europe right now. They like India right now. Office even with the depressed valuations, they're not ready to dip their toes back in the water and start acquiring office. Maybe a year from now, if valuations continue to go down, they would. If they go down far enough, I could see them, going back in a big way. A lot of takeout opportunities of the REITs. They're looking at that. I wouldn't be surprised if they take private several publicly traded REITs because of where the valuations are. As with everything, there's opportunities somewhere is the takeaway, I would say.
And do they have any, anything else from them? So the only real estate we really have our eyes on selling are 2GC.
I'd like to reduce some office exposure, yes.
But is there any bigger piece of the portfolio than that one?
No, that's our largest single exposure.
And what's the next biggest one?
It would be the Mountain View asset, which is actually
Hopefully that's in the mountains.
No, it's in.
It's on the west. It's in
It's
Silicon Valley.
It's in what's the name of that? Palo Alto. It's an office complex in Palo Alto. We toured it a few weeks ago, 6 weeks ago, whatever. Doing great. Occupancy's staying high. It's very, very well located asset. But it's like a three or four building complex.
Is that the one where there's 3 or 4 buildings?
It's 3 or 4 buildings. Yes.
It's got a spring. It's got some water on it. Trail, and is that the one?
Is that Water's Edge? Thinking of Water's Edge?
Okay.
Yeah, but they're all separate account assets.
So what is our investment in that? In the one that we just talked
I think our NAV currently stands around 160 or 70 million in that asset, which 2GC was $260 million NAV. It's probably marked at 160 now. So.
Okay. So what's going on around 2GC?
It's 79% leased. Long Island Railroad is open. Midtown Manhattan is very, very challenged right now, but the fact that we are steps away from the Grand Central Station will help us. If we were 1-2 blocks away from that, this asset would be very, very challenged. But I believe it'll come back in time, given its location. It remains to be seen. It's
That doesn't
very,
come
very-
until 2025.
2025 until that comes
We've
due.
got a term on the debt, so no issues there.
And even when it does come due, we should be able to refinance it.
Ron refinances it 1,000 basis points. For sure. Isn't there something being built around that that's world renowned?
Well, RXR, our new partner on our mixed use development project, has announced a very, very large building that's going to actually be built on top of Grand Central Station, 2.5 million square foot, trophy office building. That's apples and oranges though. We wouldn't compete for the same tenants. That they're talking to, I don't know the names that they would say. I can speculate, but they're talking to a couple people that one group may take the whole building, lease it before they ever break ground. So what we compete for at 2GC is a little more back office type companies or smaller companies, not.
What's the status of that project?
It hasn't broken ground yet. I would say probably in 2025, they would break ground on that and finish it up in 2029. Is I think their timeline.
Okay. Any other questions? I've taken up all the time here. So, I don't think so. Thank you very much.
Thanks.
We're now down to our public comment section.
IAC Code of Ethics.
Huh?
IAC Code of Ethics.
Anybody sign up for public comment?
No one has signed up for it.
Code of Ethics.
Thank you, Treasurer. IAC Code of Ethics Annual Review. This presentation is directed to the IAC members. You're required to review the IAC Code of Ethics annually. I won't review the entire policy. It should have been sent to each of you separately. I will, however, highlight a few of the key components. There have been no changes to the policy since the review last year. Section 3 restricts transactions between interested parties and the retirement systems. Interested parties means either an IAC member, the spouse of an IAC member, any partnership in which an IAC member or spouse is general partner or holds 10% or more interest, or any corporation in which an IAC member or spouse owns or controls 10% or more of the outstanding stock. Section 2 requires recusal from voting or evaluating investment matters when an interested party is involved or the IAC member is an officer, director, or employee of the involved entity. Section 6 requires confidentiality, and Section 8 establishes a duty to proactively identify and promptly disclose to Department Compliance Counsel potential conflicts of interest or code of ethics violations if an IAC member becomes aware of any. For any IAC member who has not yet provided their signature to the annual acknowledgement form, IMB staff will work with you to get that signed and delivered to us, which we'll keep on file. Any questions about the IAC Code of Ethics or about its requirements? We'd also like to highlight briefly some of the important IMD policies related to ethics. Next slide, thank you. It's a little bit hard to see, but this is a list of key policies which govern the Investment Management Division. These policies are reviewed annually or every other year so that there's a regular, consistent look at these policies to make sure that policy and practice are still in line. There have been no major changes to this list of policies this year. Any questions from the IAC members about any of these policies or anything else in this presentation?
Any questions?
Okay. No more questions. Thank you for your time and attention. It's important that we perform this review annually, but also glad not to take too much of your time.
Thank you very much. No one signed up for public comment?
No, sir.
Here, I deem the public comment section be closed. We'll go around the horn to see if anybody would like to comment. IAC member. Any members that like to comment? You wouldn't mind speaking, that'd be great. Okay, hearing none, I'll entertain a motion to adjourn, and I'd like to adjourn our meeting today in honor of Memorial Day. Those who have served our country, those who have killed a lot of duty, and the tens of thousands that continue to be missing in action. So,
Greg Madison, so moved.
thank you, Greg. Any further discussion?
This is Loris Coakley, second.
Thank you, Loris. Any further discussion? Hearing none, the clerk will call the roll.
Mr. Anarella,
Yes.
Mr. Brewer,
Yes.
Treasurer Falwell.
Yes. Thank you so much. We're adjourned.